Welcome back to Brave Ideas. Today, we're diving into an episode packed with insights from our guest, Ben Wright, Global Head of Partnerships at the Instant Group. Ben shares his vision for using data to bridge gaps between landlords, operators, and investors, revolutionizing the decision-making process in the flex industry. His take on collaborative industry efforts follows on nicely from the final episode from last season about the UK's Workspace Intelligence Network. Before we get into this episode, I want to welcome my friend, co-founder of Return Suite, Sam Gamble. Return Suite is our headline sponsor this season. Sam, you were in the room for this conversation, so I know you've got a lot of thoughts on this. Let me ask, what stood out to you the most?
Yeah, thanks. I kind of got surprise pulled into that one. My first takeaway is, Ben just has this interesting background, right? Coming into the industry, first as an economist, and then being involved in software in the flex industry, and now being at Instant. He just has this kind of really interesting view of the market and what's going on and what's needed to help grow the flex industry.
Yeah, his previous company, Upsuite, was really diving into what he calls nerding out on the data. And he talks about that's a big part of bridging the gap between the operators, landlords, and investors, which kind of follows on nicely from the last episode with Gio, I think, when it comes to back to the valuation topics. On that note, somebody who's actively helping solve this problem with Return Suite, how do you see these data trends shaping the future?
Yeah, it was really interesting to hear his kind of nuanced view on data and how, the different levels of importance data can play and how it can help with things like lending and helping investors make decisions. You can just sit there and listen to him talk, kind of throw out a question and then just just let him go, right? and just be kind of fascinated the whole time with what he's saying. And, it was also really interesting kind of what he was talking about, how he's seeing information that the investor profile is changing within the office market because the risk profile is changing. And so I found that kind of interesting. And it's what we've been talking about and a lot of other people have been talking about or predicting would probably happen. And it was kind of interesting here that it's, starting to come true.
Did he say anything in this conversation that made you rethink your approach?
A few things he said just about, ultimately the investor's right. If the investor wants to pay a certain way and analyze a deal in a certain way, you can't really kind of impose a valuation system on the investors. They're the ones spending the money. And it didn't quite make me rethink anything, but it was just an interesting way to phrase it. And I thought it was kind of really, really kind of gets to the point and gets to one of the main issues around valuation, where it's kind of a little bit of a circular reference problem where people are waiting for valuations to change, but valuers really are just trying to reflect back to investors how other investors look at something and decide and internally value it, right? So the valuations can't really get ahead of investors.
Well, I'm sure that's music to the ears of our mutual friend Benjamin Bach over in Kitchener-Waterloo. He's always commenting on socials about that very same topic, but let's not spoil it anymore. We need to dive into this conversation with Ben and let everybody hear what he had to say. Welcome to Brave Ideas, Ben.
Caleb, good to see you.
It's good to see you.
I am seeing you, by the way.
In person,
we're actually not on a Teams call, which is pretty
not
cool.
on a Teams call, and we actually have seen each other twice now for 2 seconds each. So we've sat down and we've talked for 5 minutes now, and this is the longest I've ever hung out with you.
But not on this continent.
That is true.
Yes.
First time. Yeah.
2 different
Always
continents.
been in Europe.
Yeah.
2 different countries.
Yeah.
Well, there you go. We also have Sam Gamble in the room with us. Sam is my friend, my board member, and also fellow entrepreneur from Return Suite, who's the sponsor of this season. Sam, say hello.
Hello.
We're gonna have.
That was a Canadian answer.
That was a Canadian answer. Yes, and Sam, don't forget, we have a gift for you after this.
Is it food?
Straight from Canada.
Yeah.
Oh, okay.
It is edible.
Okay. Can't wait.
But sorry, let me clarify. It is not edibles, but it is edible, but not edibles. Okay, sorry. We won't cut that out. But no, on a serious note, I do have a question, a few questions for you, Ben. I'm I think, look, you've seen, you're very close to the change that's been happening in our industry. The demand for flex is growing, the stress in office is happening, uncertainty in the market, blah, 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 blah. And we've talked about this a couple of times today already, but there's a more collaborative relationship between landlords and operators, where it might, in the past, dare I say, be combative, where it's a lot more collaborative now. But one of the things I keep hearing over and over again in my conversations is, show me the data. What is the track record? What is the financial data? So how important in what you're seeing globally is data to the growth of Flex?
You said keep it short, but so I'm going to give you a long answer quickly. Well, first of all, everybody kind of talks about data like it has value in itself. It doesn't, right? So in my early part of my career, I was an economist, and I kind of learned there's data, which is a bunch of numbers on a spreadsheet. Then there is what the data means, right? On top of that. And then there's what the data means you should do, or what it means to you. Those are three totally different things that are interdependent. So I don't think you're asking about data. So I'm going to ask you to reframe your question, because data is just numbers on a page. Not to be.
Okay.
I just love being in person, so I'm really enjoying it. So let's go with that.
Well, we can always talk about the human touch and everything like that, but and humans are important to everything we're doing in Flex. But I think what you're pointing to, or what you're alluding to, is that it's understanding of what the data means. It's making sure that we are looking at the right data, and it's making sure that it's transparent enough so that the collaborative conversation between landlords and operators work. So what's missing to make that happen?
Yeah. So I think there's things missing up and down the stack, right? So, and by the stack, I mean the people that operate buildings, people that manage buildings, and the people that invest in buildings. So I think to make buildings valuable, and we all know the value has dropped anywhere from, call it 50 to 90%, depending on where you are and what the asset is. And that's a dramatic change, and it scares the what out of anybody that owns assets, right? So applying data to that, applying just a bunch of numbers to that doesn't do it. The way that buildings have been valued, and Sam, I saw this from you in Las Vegas at ULI, there's multiple methods to do it. Each one of those is, what does it mean for you? So you applied all these analytics and algorithms and perspectives and benchmarks to turn data into that meaning. And so the way we think about it, the reason I joined the Instant Group, and my role at the Instant Group is I run the partnerships business. So every landlord, every operator actually on the planet is my customer. I don't know them all, but I've been to about 700, now 701. Well, I guess this isn't a co-working space, but I've been to a lot of spaces in a lot of cities. And the common denominator is, okay, how will something that's inherently short-term, how can I predict its future, right? That's really what anybody who owns an asset or invests in an asset really wants to know. That's easier to do when the change points are shorter or more predictable, right? Like in 10 years, something, I can rely on this with a certain understood level of risk for 10 years. That's different than I can rely on this with a month-to-month risk. And so people are scared of that. A lot of the innovators like you, Caleb, are like, look, I've seen it, I've done it, I've had success. You've had some locations that probably didn't work out, but you understand the risk. If not, you would not be doing what you're doing. So I think it's about, the challenge right now is how you turn information, of which Instant has as much or more than anybody on the planet, into something that means something, not to the operator necessarily, although they'll use some of it, not necessarily to the property manager, but to the investor. And so that's again, just a reminder for the group out there, Flex is 3 to 5% of the office market today, growing, but still not mainstream. So we're on this journey to try to solve that, as are you both.
In that solution, one could argue that the value for that solution is for the operators, because if the investors understand the money will flow, it makes it easier to do deals with landlords. Mm-hmm. But maybe the real value is for the investors, because if the customers and the demand is for more flex, and you can't invest in flex because it doesn't work for your investor business plan. How does the data coming into this, the right data and understanding that, how does that change the business plan?
Yeah. Well, again, I'm going to get total data nerdy here. When I joined the industry in 2017, I was a quantitative person. I'd built web applications that helped companies choose locations, 1 million sessions a year. So I'd watched all over the Western Hemisphere companies looking at new locations, and it was super cool, and I liked it, and I'm a nerd in that way. Co-working was interesting, and commercial real estate was interesting to me. I joined it in 2017 because the recency of all the data, the closest in recency was a quarter, and people didn't really pay attention shorter than a quarter. I would argue they might not even pay attention except for a year. And so there's such a gap in there. And so we learned some cool things, and sorry for the long answer. There's seasonality in commercial real estate. Nobody talked about that. Like there are different days of the week in commercial real estate. Now people talk about that a lot, but they didn't in 2017. If you talk to Brandon Medeiros, there's different types of day for different products that you can sell at different margins, right? So that's fascinating to a data nerd like me. So the challenge is, is A, who's that valuable for? It's valuable for operators because their pricing can be variable. Some really cool stuff that some meeting room folks are doing around dynamic pricing that I think is exactly on this path. I think there's some interesting things that operators are doing, varying different prices at different times for different things. And I think it's only getting more complex, meaning the diversity of products is getting more and more complex. And so the pricing models are getting more complex, and it's more and more global. So my favorite part of this was to take our data, see who's looking on a block by block basis, and figure out what somebody could charge an asset A, B, and C within, if you're in New York, within 2 blocks of each other. And it was quite different in some cases, 20%, 30% different for the same thing.
And what was the drivers behind those variances?
Could be a bunch of things. In New York, it's things like, or actually I'll use Toronto for a Canadian example. Kane Wilmot taught me this one. On the path, not on the path.
Yeah.
You know what the path is?
The public transportation.
Well, no, the underground walkways.
Right.
So you don't have to be in the freezing cold in the winter, right? So if you never have to come outside, there's intrinsic value. In fact, Kane would tell you, I think this is still true, he won't open a location in Toronto if it's not on the path, right? So that's one. And that can be block by block. Another thing is the asset. Like, what does the building look like? Like, I'm your worst podcast guest ever because I just keep talking. But I think one of the, I don't have access to all this, but one of the things I think we've seen is trophy assets. What you can charge for a desk in a trophy asset relative to the rent that you have to pay is less than you can charge in call it a class B asset that's next to the trophy asset. You can make there's a bigger delta between the lease rate that you pay long-term and the price that you can earn with a flex center there. And folks like WeWork would, if you got, Kate Harper drunk, she would probably admit to some of that. I don't know that. She never told me that.
Just for the record, we're not advocating drinking alcohol, even though I had some wine earlier. We're not against it either. But
Kate's on my panel tomorrow, so I don't know when she'll hear that, but that gives you a date, Kate. So,
okay. Well, going back to the question about value and who's it for, but if you're talking about this information around the operator and how well they're going to do and the various variances on the lease model, the landlord wants to know how well their operator on lease model is going to do, just as much as they're going to want to know how well they're going to do if they're on a management agreement model, right?
Right.
So what about the lenders, though? Where does this data sit for them?
Yeah. Really complex for the lender, unfortunately, which is why it hasn't gotten solved yet. One other anecdote was when I first started in the business, I realized that a subpar operator in a great location could do great. A great operator in a crap location couldn't. And some things changed, like Caleb, you're an absolute innovator in the industry, but location still matters. But it's not the same definition of location. Trophy asset means higher rents and whatever. That thing's broken. Also, the quality of the operator matters. You're dealing with something that has far more touch points, far more hospitality elements, far more, call it experiential points that drive success or failure. So that creates additional risk and again,
or de-risks,
right? But if you're a lender, you're looking at a whole different set of data than you were before. If you were lending, for example, on a hotel asset, you could use a star report and say, oh, within this risk profile, there's more demand for hotels than there is supply. So we can charge this amount. We can calculate this RevPAR. This is within my risk tolerance, so I'll do it. That data exists in a really messy form. But one of the things that's really exciting about Instant is we have access to about in many of the 40 largest markets in the world, about 15% of all the transactions that go on in that market for a year, right? That's more than the Star Report uses to create those answers. So the challenge is, we've got the data, how do you make it mean something? And how do we make it mean something across these different use cases, which are for an operator, an owner, an investor, or a lender?
That's why
I was at ULI. And you saw me ask, hey, so I'm talking to Sam right now, but those are the questions. What are the use cases, right?
Well, I want to bring Sam into this because I think that's a good segue. Sam, you gave an amazing I wasn't there, but I've heard it was amazing from a few people at this event. Can you talk about what you addressed in that panel, in that presentation?
Yeah, I mean, basically it was just going through the different potential valuation models and what that actual effect would do. So if we valued it normally, basically the same property, pushing it through different models, and kind of where I think the eventual solution is using more of a risk-adjusted model or expected valuation model, and that requires using operating data instead of market data. And
can you just, sorry to interrupt, but can you just talk about the difference between the two?
Yeah, well, actually, it's funny enough, I've heard you explain it probably the best, the idea of looking backwards to project forwards. So rather than kind of using kind of comp data, well, this is in general what the market does and has done. You actually look at your own asset and say, okay, the last 3 years, it's earned this much and kind of this much variance, and you can kind of use that statistical stuff to kind of figure out the valuation and cash flows going forward.
Honestly, I'm not sorry not to interrupt your flow, but I think that use case for an individual operator, individual owner for an individual asset makes a ton of sense. If you're an operator evaluating a new market that you're not in, which is honestly we get asked for that way more than that, because it's like, God, I'm starting from scratch. How do I look at Vancouver, or how do I look at Hong Kong?
Right. Yeah.
You need a different method, or operating data from somebody else. That's a tough one though.
Right. Yeah.
Right?
Yeah. Now I guess you're talking about kind of benchmarks and the idea of the Star Report out of hotels, and I found it really interesting what you were talking about there. But what data do you guys want? What data do you guys think would be useful?
Right.
And then I guess there's this problem where the ideal situation is you get all, as an operator or a landlord, you get all the data but don't have to provide yours. But of course that doesn't work on a system level. Like do you have any ideas like how you would tackle that?
Well, I mean, so Instant's in an interesting spot because it's an intermediary, it's a marketplace, right? So we get very, very wide data that's not that deep, right? So the panel that we did on at ULI, we partnered with Yardi to do it, and Yardi's got this operating data for going really deep, and accounting data for operating centers, which is, admittedly very valuable. for certain use cases like margin calculation, pricing, things like that, super powerful. What Instant can do though is, hey, how do you take market level pricing, for example, and overlay that onto that? Or how do you understand a market that you literally have no operating data for? And again, somewhat more limited, like what did this transact on this date and for what price and what was the product? That's the kind of stuff that a marketplace has as opposed to an operating platform. Both valuable, but pretty different.
Hey everyone, Caleb here. Let me tell you about something that's going to totally change how I work with real estate spreadsheets. If you've ever been stuck in endless tabs of complex cash flow models, you know the pain I've experienced. I just saw a demo for Return Suite, and I've got to say, I'm excited to try it out. This platform is about to make our lives so much easier. You can model cash flow scenarios in minutes, not hours. It's like a breath of fresh air. And here's the cool part. Their co-founder, Sam Gamble, who helped kick off this episode, is looking for 3 beta partners to test their flexible leasing model. Whether you're managed co-working spaces or flex inventory, this is your chance to get early access to something groundbreaking. Let's simplify financial analysis together. Join me as a beta partner and check it out at returnsuite.com/brave.
Sam, you mentioned earlier the multiple valuation methodologies. If I'm repeating that the right way, but why isn't it important to look at multiple versus picking one?
Yeah, that's a good question. I guess essentially, there's just like this whole kind of, you could kind of think of it as a family tree or a tool chest of valuation methods. And in real estate, we've kind of fallen into the trap of only looking at one when it comes to kind of income producing properties, and it's the direct capitalization method. And it's really, really similar to bond valuations, and which makes sense if you're valuing a set of cash flows that's based on a 10 or 20-year lease. So you got to get stuck in this method. And I almost think of it as like back before we realized that the Earth circles the sun, we thought everything circled the Earth. You keep adding these planets, and sorry, that's a long explanation, but
not as long as mine. You're doing fine.
Basically, just like as more and more flex comes into the market, kind of shorter leases, we keep trying to jam this into this old paradigm, this old model of valuing stuff like it's a bond, but it's not anymore. And what we need to do is kind of zoom out and go, hey, let's go back to the toolbox and look at some of the different valuation methods. And there's like maybe a dozen different methods. I mean, you could value stuff like their options. I mean, one solution could be just, why don't we just value properties with flex based on the actual replacement cost? I mean, that's been a suggestion for hotels. What would it cost to rebuild? And so, yeah, basically there's maybe 5 or 6 that make sense for flex leasing. And I think it's just time to kind of go and look at one of these other ones.
And the nerd that you are with all your algorithms, Ben, what do you think about this? Do we need to pick one, or should there be a couple, or is it a blend?
Well, I'm interested in what you're doing in this way, Caleb. And so I'll come back to the question, I'm sure, but I have to think that what you're doing is saying, hey, I've got some expertise in this new kind of demand to activate buildings, generate cash flows, whatever. You've partnered with somebody that really understands capital markets, right? The combination has to be, we're going to take an asset that's valued at X and turn it into something that's valued at Y, if you're going to own the asset, right? So, that in itself is fascinating. I'm a little bit of a realist in terms of choosing the model. You choose the model that the people with the money want you to choose, right? That comes from my marketing days and sales days, where you use language that your prospect will understand. And so if you're talking to a bank, you've got to use the method that they want. Unfortunately, I have a terrible story about doing that once, and I can share that with you at some point if we have time.
Well, you actually remind me of my friend Benjamin Bach up in Waterloo, Kitchener-Waterloo, Canada, from Cushman & Wakefield. And he's always saying, there's no valuation problem, it's an investor problem. If you want an investor to buy a property at whatever price, you need to target the right investor.
Yep.
And so maybe that's the answer. And do you think that as we move away from this bond-like investment profile to something that's more volatile, dare I say riskier? Some might say it's less risky than a long-term lease. Is the investor profile going to change?
That's exactly what I've seen happening. So I'll give you an example. We've met more than a few investors and we've asked them what their thesis is, who are buying buildings. And there's not a ton of them. There's some big funds now raised in the US to take advantage, and they haven't been super public about how they're deploying their capital yet. But the ones that have, the small guys, it's private equity, looking for private equity returns, willing to take private equity kind of risk. They're buying and really not doing much with the asset, from what I can tell. They're saying, well, in 2018, it was valued here. I can get it for 70% less than here. I can write off the flex, make it worth zero, and I can lease the building traditionally. That's a model that we've seen more often than any other in terms of people buying buildings today. That is not the sexiest answer talking to this room, but that's what we see, and that's the state of it today. It's, well, I believe the world's going to come back the way it was. That's basically the thesis in that. And there's a bunch of people who have bought real estate in distressed real estate and done exactly that, retail centers and whatnot. So could that be how this turns out? Yes. If you're in the flex industry, though, do you believe that it's going to come back the same way? No. So I think there is room to find the right investor, but those investors those are some of the same investors that bought into WeWork, that, might buy IWG shares, because those are the most liquid, or might buy
a hotel.
Might buy a hotel. We've seen some of the franchisees that have come into the co-working space are hotel operators and owners, especially early days with Serendipity and others. They recruited a lot of hoteliers who were comfortable with the risk profile. So yes, I do think the investor is going to change. And the other thing I'd say about it is the really savvy office owners, you look at them now and they're like, yeah, we sold most of our portfolio in 2019, 2020, and put it in industrial, put it in multifamily, so on and so forth. So it's if you go to some of the real estate conferences, ULI included, Blueprint. Also, I've been to both. The office market the office representatives are very thin there. Like you don't see as much office. You see the other asset classes. So that's real estate.
Well, I think we could probably go very deep on this and do probably a whole season worth of valuation. And maybe some people listen to this podcast and felt like I have covered valuation every season, but it's an important topic.
There'd be like two people that would like that.
Yeah, well, Benjamin might roll his eyes if you're listening, Benjamin. High five. I do want to ask, just because I think everybody's curious, what's up with Instant? What's going on? You guys have been making lots of moves. When I interviewed John Williams last season, he wouldn't give any clue on what's happening, what's going on. He just said big things are coming. What's coming?
Well, what's cool is it's already here, and that's great. It's been years. I joined Instant in March of 2023, and there's really a 3-phase kind of release of new technology. But basically, what we've done is, Instant has been a global marketplace for flexible workspace. And what that's really meant is the company's done two things up to this point really well. It's been a good broker. About half of our business is putting large multinationals or what we call multi-location clients into Flex all over the world. That's a good chunk of our business, 10 to 15% of it. 5% or so is consulting and advisory. Do some really cool consulting for occupiers around sustainability and procurement. Then the rest is running what we call managed office, or what we call work-a-made, which is single tenant, small, flexible offices, usually for large corporates, right? So we call that work-a-made. So that's the business. And the Instant is not immune to the changes that have been going on. It is one of the biggest. We've been fortunate to be profitable and do some things, and as a result, we've been able to invest in some things. So what we've invested in addition to tons and tons of product development on the Workmade side, is the complete retooling of our marketplace. So there's 3 pieces to it. There's a new, we call it a partner portal, or, probably the least sexy of them, but that's the part that I am rolling out to the market right now with my team globally. It's where you put your listings, it's how you get your leads, all of that stuff. That's called the Work a Partner portal. We're going to launch a marketplace on the back of that will, I don't know if everybody knows, but Instant has dozens and dozens of sites. There are really 5 or 6 primary ones all over the world that drive demand into that. But that's what the marketplace is. And then third, we're launching a product for corporates to book and manage budgets and utilization and so on and so forth, called Team. So those 3 things are rolling out. And for me, I'm an entrepreneur at heart. I was an entrepreneur for real from 2001 until I joined Instant, basically. Started 2 companies and sold them both. What the rollout of the Work a Partner portal is for me is the ability to really get close with our operators and talk to them about how the world is changing, how we're supporting it with technology. We also had a really dated portal before this that I remember I went and met with an operator, one of the biggest operators in Mexico. And they said, Ben, I really like you. This was like 3 months ago, but your partner portal's terrible. And can you just fix that? And I was like, yes, we really can now. So in 3 weeks, we've signed up 550 operators globally, just including the Thanksgiving holiday, which is pretty cool. And that's my team doing that. And it's fascinating because going back to the beginning of our conversation about all the different products that are available in Flex, it's designed to accommodate everything from meeting rooms to VO to book and pay for an hour booking to long-term corporate agreements, right? So it's really a big platform. Then here, again, I'll tie it back to another part of our conversation. We've built a really sophisticated data warehouse behind it to where we can track really, we already have the largest and the longest and the oldest data set, but now we've got the infrastructure to really make that meaningful and flexible and all of that. So it's been a huge investment by the leadership of the company, very visionary. And my role is to really take it to the market, especially the operator and landlord market. So it's an exciting time to be at Instant.
Well, it sounds like to me that you guys are creating more opportunities for more data, more transaction data, more operational data that Sam was talking about earlier. So the future is exciting. I wish I could say we're going to end it right there. Sam, before we close this out, any final words?
Yeah, no, just wanted to thank Ben for coming straight from the airport, fighting traffic, coming in the evening to come and see us and chat with us. Thank you very much. It's great to
my
see
pleasure.
You.
Honestly, I feel like you're going to be one of my biggest customers one day. That's my
very nice.
You've got the modeling, the algorithms, and we've got the fuel.
Yeah, well, that would be perfect. Definitely, I think, smart operators with good data and the right modeling tool. I think kind of world's our oyster.
You do have to release the product. Take it from me at Instant. We've been talking about launching Worka for 2 years.
Yeah.
Got to release the product.
Yeah, within days. So.
Well, I wondered who's going to be the customer of who. So I'm glad you clarified that, Ben. Look, fantastic. It's good to finally see you in person, and let's go catch up.
Let's do it.
Thank you for tuning in. Until next time, take care of yourself.
If you've enjoyed this episode, you'll enjoy our Brave Ideas newsletter. Subscribe today by tapping on the link in the show notes. And don't forget, I'm always on the lookout for buildings to acquire and reposition with brand-led hospitality. If you know a building I should look at or an owner looking to sell or partner with, drop me a DM or contact us at bravecorp.co. Until next time, take care of yourself.